Okay, if you've been tracking the Indian financial sector at all lately, you know that banking is, well, it's the absolute powerhouse of the whole economy. Today's explainer is going to unpack a highly anticipated and honestly very targeted new entry into the mutual fund space. We're looking at the Groww Nifty Private Bank Index Fund. We're going to look under the hood, figure out exactly how this NFO functions, and see whether this concentrated slice of the banking world actually deserves a spot in your portfolio. Let's get right into it.
Here's a quick look at our roadmap for today. We'll start with the new fund offer, look inside the private bank index, break down the passive investing mechanics, discuss the economic backbone, and finally, weigh the risks.
Okay, let's dive right into Section 1, the new fund offer.
So timing here is absolutely critical. The NFO officially opens for subscription on May 6, 2026. That gives you a precise 2-week window before it closes up on May 20th. But hey, don't sweat it if you happen to miss that first window. Because it's an open-ended scheme, the fund actually reopens for regular purchases and redemptions within 5 business days after that initial allotment. And from there, you can easily set up your standard daily, weekly, or monthly systematic investment plans.
Now, what makes this specific fund so accessible is the incredibly low entry barrier. The minimum investment? It's just 500 rupees. I mean, that's basically the cost of a decent pizza, right? Whether you're dropping a lump sum or starting a recurring SIP, that 500 rupee threshold ensures practically anyone can get some skin in the game without needing to tie up massive amounts of capital up front. It really lowers the barrier to entry.
Moving right along to Section 2, inside the private bank index. Let's look at the actual landscape.
Look, banking is definitely not a monolith. You might actually recall that back in 2025, PSU banks, those are the government-backed ones, went on this massive rally. They generated roughly 25% returns compared to the broader Nifty 50's 9%. It was huge. But, and this is absolutely crucial to note, this specific Groww fund strictly excludes those government-backed banks. It focuses entirely on the private sector. And the private sector operates with completely different dynamics, distinct balance sheet structures, and totally unique growth trajectories.
We are talking about the absolute heavyweights here. The fund manager will be deploying capital into massive private banking giants like HDFC, ICICI, Kotak Mahindra, and Axis Bank. And remember, because this is an index fund, your money is distributed in the exact same weightage that these individual banks already hold within the Nifty Private Bank Total Return Index. So, you're essentially buying the meticulously proportioned slice of the entire private sector's top tier.
All right, Section 3, passive investing mechanics. Let's demystify how this actually works behind the scenes.
So, in a passive fund, the managers, Nikhil Saram, Akash Chauhan, and Shashi Kumar, they aren't out there actively trying to beat the market. They are just trying to accurately mirror the index. But, a perfect one-to-one match is practically impossible in the real world. This introduces something called tracking error. Driven by everyday operational realities like undeployed cash sitting around or slight delays when they rebalance the portfolio, the fund aims to keep this tracking error strictly below 2% on an annualized basis. Pretty straightforward stuff.
And this brings us to one of the greatest advantages of the whole passive model: radically lower costs. Because they aren't spending massive resources on active stock picking and deep research, the maximum expense ratio legally permitted here is capped at just 1% of daily net assets. That means a minimum of 99% of your capital is fully invested and actually working for you in the market. And honestly, in reality, passive direct plans often run much, much lower than that 1% maximum cap.
Flexibility is another massive feature we need to talk about. The exit load for this fund is exactly 0%. Yep, zero, zilch. If market conditions suddenly change and you need to redeem your units or pivot your strategy, there is absolutely no penalty fee eating into your capital. It's a highly liquid setup designed for agile investors who want options.
Which leads us to Section 4, the economic backbone. Why does this sector matter so much?
To really put this whole sector into macroeconomic perspective, I want to share a quote from our sources. The banking sector is the backbone of the country. If banks crash, the whole country shakes. Now that isn't just dramatic hyperbole, it's reality. Think about it for a second. Every single corporate transaction, every business expansion, your retail mortgage, it all flows through these exact institutions. By holding this index, you are making a direct, highly concentrated investment in the absolute engine of the nation's financial system.
Finally, Section 5, weighing the risks. It's time to talk about the vulnerabilities.
Now, what's really interesting is the official scheme riskometer, pulled straight from the fund's compliance paperwork. It is unequivocally pointing right into the red, very high-risk category. The super low minimum investment and the automated passive structure might make it sound really safe and easy, but make no mistake, the actual underlying asset class is officially classified as highly volatile.
So why the very high-risk label? Well, first up is concentration risk. This is a thematic, single-sector fund. If the banking industry faces sudden regulatory headwinds, your entire investment feels the unmitigated impact. There are no IT or pharma stocks in this basket to cushion your fall. Add in interest rate risk, because banks are incredibly sensitive to central bank moves, plus liquidity risk during extreme market downturns. You are willingly trading the safety of wide diversification for aggressive concentrated exposure.
Which leads us to our final takeaway. Our sources make it totally clear that concentrated plays like this rely heavily on market cycles and demand a seriously long time horizon. We're talking a decade or more. So as you look at your own portfolio strategy today, the ultimate question you have to ask yourself is, do you have the 10-year vision and the ironclad risk appetite required to ride out the volatility of a pure private banking fund? It's an incredibly powerful tool for sure, but it's one that demands absolute conviction.